Hi guys, Harry Yotis here, professional trader for 20 years now. Started my career in 2005 and still alive and going strong in 2026. Well, big news of the day today being this red candle here. Started off well, sold off, finished in the middle. Okay, this is Wednesday, the 11th of February 2026, and the big news of the day is jobs report 130,000 jobs added. Woohoo! Celebration. What recession, guys? Everybody's bearish. What recession? Okay, we'll get to that shortly, of course. We talk about the technical picture first. Let's bring in the moving averages. I mean, even without the moving averages, you can still, it's bullish. We're hovering around the highs. Try to break it today, we couldn't, but still a series of higher highs and higher lows, although a lot of volatility in between, okay? Moving averages, still above the 50, still above every other short-term moving average, okay? Bullish. It's not going to change unless something dramatic happens. It's not going to change. We are still bullish. We are long this market, and we should be net long this market. Okay, let's pair it now with the sentiment. We always talk about the sentiment. Fear and greed index smack down in the middle of neutral. Okay, perfect. The sub indices momentum is still at fear. Interesting, because we haven't cleared anything. We have strength. The stock price strength is there. The breadth is there. A lot of sectors, like we saw last time, are participating. Consumer discretionary, semiconductors, industrials. These are the good sectors that you want to see, and you want to see breadth expand beyond tech, which is great. Okay, but put call ratio, people are still fearful. Exactly what we want to see. Okay, VIX is basically neutral. We're not at lows. Everything else is at fear. So basically neutral. We're at neutral, plenty of room to go higher. This market has not even experienced anything that is close to euphoria or happiness at the highs, which is exactly what we want to see as bulls. Okay, so let's talk about the big news of the day. 130K jobs added. They were expecting a 65K. Okay, and the previous was 48K. So they got way higher than expected. Okay. The news was that there was an across the board jobs report, but take it with a grain of salt, okay? What they're trying to say here, like almost everything about this report was good. Big jobs beat, okay? Here, private jobs crushed it, adding 172K. That's right. Saying that public sector jobs, government jobs shrank because, 172. Private, 130 total. The difference, 42K, is a loss in the public sector of 42K jobs. That's great. But there were a couple of downward revisions going up. And the benchmark revisions were minus 862,000 jobs. However, that is totally expected, and that didn't tank the market. And the unemployment rate dropped. So this is all good news all around, okay? So this is what is there to complain about? Well, NSA, non-seasonally adjusted jobs, dropped by 2.6 million. We added 130K, but we seasonally adjusted that up by 2.6 million jobs, okay? So people say without that, we would have lost a crap load of jobs, and that's okay. But I want to show you guys the visual here. Again, all this from Zero Hedge. I'll show you this chart right here. Oops. Okay. This is the non-seasonally adjusted jobs report, minus 2, if you can see it here, minus 2.6 million. However, look, everywhere in the past, every January, there's always a downward revision, huge one. Okay, it's not a downward revision, it's the non-seasonally adjusted jobs, and they get seasonally adjusted every January. Okay, it happens every year going back. Look, this goes back to 2021. This is a January. If we didn't see, you can, what we said this January, basically we can say every other past January. If it wasn't for seasonal adjustment, we would be minus 2 million jobs. The sky's falling. Okay, so no, it happens every January, and it's normal, and that's why people are trying to find some negativity in this report. Yes, that is something to watch out for, but it happens every year, and it doesn't tank the market. Okay, so basically, this market is, it's just taken with a grain of salt because of this 2.64 million non-seasonally adjusted, but we always seasonally adjust, and it never tanks the market before. Okay, and finally, this is what you say: the market has immediately priced in more hawkish Fed with rate cut expectations tumbling. Okay, what do they mean by that? Okay, if we go to the Fed watch, everybody wanted rate cuts, and rate cuts are supposedly good for the market. Okay, that's why gold is ripping supposedly. That's why commodities are ripping, because everybody thinks rates are going to go down. Well, this is the Fed watch tool. Okay, for March of 2026, 94% chance the Fed does nothing. Okay, I think it was March or April. If you go to April, 78% chance the Fed does nothing. Okay, this is no change. Okay, this, I think, previously, like when we were in December of 2025, I think the first rate cut was going to come in March or April. Okay, and that's off the table. So there's no chance it's going to happen in April or March. So when is the first rate cut supposed? Well, here we go. By June, they expect one rate cut. Well, a 48% chance, pretty even. We might not even get it. Okay, and if we look at all of 2026, this is December's meeting of 2026. There's the majority is this is no change, 3.5%. They expect it to go down to 3%. So 2 rate cuts are priced in. Is the default expectation for all of 2026. Just 2. And the first one coming probably in maybe June. Okay, so it goes to show you that this market doesn't really care about rate cuts. Okay, and does that affect anything? Like, if you expect a more hawkish Fed, less rate cuts, you expect the dollar to go up because it's catching up. No, we're not gonna devalue it as fast. Nope, flat. The dollar had no reaction to this, still bearish. Okay, the dollar is still bearish, even though we keep pushing back the rate cut, which should be bullish for the dollar. It's not, okay, because there are other factors happening. This is a consistently weakening dollar based on other macro factors. It's not just rate cuts. And the market basically shrugged this off, okay? Like I said yesterday, we're going to pair this analysis with the psychology of the market that we talked about yesterday, okay? We have the news, it came out, the market digested it, and that's it, it's over. Now the market can come and drift back up, okay? The Fed watch tool, the fact that we have, the first rate cut coming in maybe in April, and basically 2 rate cuts for 2026 has done absolutely nothing. We were pressing in 4, I think, before. So we cut that number in half, and the market's still at highs, okay? It doesn't care. Why? Because now the economy is doing better. Okay, remember we said our base case, if we have jobs between 0 and 100K every month, this is positive news. The economy is not tanking. Okay, we're getting better. The fundamentals are there. We have the fundamentals on our side. We have the technicals on our side, bullish, and yet people are still neutral, fearful, buying puts. Okay, everybody's believing Twitter and not believing the fundamentals. Okay, it's crazy. So you have that, and the next big thing, okay, this trader psychology, we got this out of the way, okay? Now we can start drifting upward, except they're going to mention Friday we're going to have inflation, okay? And the inflation print. Everybody now is going to be worried about inflation if they switch between jobs and inflation, which is the Fed's mandate, okay? So what I did notice today on Wednesday is that the CBO sees large historically unusual deficits in coming decade. Okay, so the CBO sees 2.3 deficit totaling from 2026 to 2035. Okay, basically, the deficit is expected to be 1.9 trillion in 2026, and it's going to be in 2026. That translates to 5.8% deficit to GDP. The deficit to GDP, 5%. That is huge in peacetime. Usually we run 2-3%. It's double to triple that in peacetime, quote unquote peacetime. Okay, so the deficit. This is what's going to make inflation go up. I don't care what people tell you that a deficit is not inflationary. It is, because it adds new money. Okay, to the extent that this deficit is going to be financed not by domestic buyers of the debt, but by foreigners and the Fed. The portion of the deficit that is financed by foreigners and the Fed is the proportion of new money coming into the system, which is inflationary. Okay? If it was just financed by internal buyers, Americans, okay, or American institutions, it would not be inflationary because you're just shifting money from one shell to the next. You're not adding new money into the mix. That happens when foreigners buy it, because now the US dollars that were outside of the market are coming into the US market, which is inflationary for the US market. Or if it's printed by the Fed, that becomes inflationary for US market. In terms of the assets, the market, okay, we're talking about SPY right now. We're not talking about consumer prices. We're talking about stocks. Okay, so when you have stuff like this, like CBO, and to put it more mildly, here is the Congressional Budget Office projection of deficits going forward. I don't know if you guys can see it, but exactly like if we go to, that's 2025. If we go to 2026, we have a 5, if you can read it, it says the deficit is 5.8% deficit to GDP. And if you keep going, see 5.76, well, everything between 5 and 6% deficit to GDP going forward as far as the eye can see, and far as 2034, okay, during quote unquote peacetime with no recessions. Okay, this is going to be inflationary going forward. This is the worry. Okay, you have to mitigate it with jobs and inflation. So the inflation print on Friday is going to be crucial. Okay, we're going to see it might go down, but it's the CPI might be going down or flattish, but the coming deficits will be putting pro-inflationary forces into the mix. Okay, so we're going to have inflation probably sticky going forward, but I think the jobs and the economy so far are doing well. So that should be a mitigation on inflation, because the better jobs do, it's a deflationary pressure, because you create more goods, so it reduces the quantity of it increases quantity of goods, which means the money in your system goes over a larger portion of goods, which means it's deflationary. Okay, so you're going to have two opposing forces: the inflation coming up with the deficits, which is going to be, and a strong economy, which is deflationary or disinflationary, whatever you want to call it. Okay, so the point of all this is to show you guys that narratives matter, and don't get caught up in them. Okay, the jobs are great. The economy is not going to tank yet. Okay, the seasonally adjusted portion of it is normal. It happens every January. Okay, it's nothing to be worried about. Okay, so it isn't across the board, like they said here, across the board strong jobs report. Yes. So what are these Cassandras going to say now? Okay, they're going to jump into the inflation thing. Oh, inflation is going to be inflationary. Okay, maybe not. We do have deficits coming in, but by the way, deficits are very supportive of asset prices. Okay, if money gets printed, asset prices will go up. Another reason why you should be bullish. Okay, so you have one minefield, the jobs report positive, and inflation coming up, which would, any hint that the government is going to spend or print more money, markets go up. Okay, so everything here that we have in terms of macro, in terms of jobs, in terms of technicals, in terms of everything is bullish. Okay, so I'm going to leave you guys with that. Okay, don't fall for the psychology that everything is falling off. Cassandra's, the sky is falling. It's not. So far, we have very good prints, very good reasons to stay bullish. Okay, so guys, if you like what you heard, like it, subscribe, leave a comment below, and I will get to it. And if you like for me to analyze a stock for you, the technicals, the fundamentals, just mention in the comments. I will answer all as fast as I can. So looking forward to Thursday, tomorrow, and Friday with the CPI. It's going to be another one of these, Cassandras, maybe. We'll see. Okay, later, guys. Bye.